Wondering how ETFs can fit into your portfolio? Join us for our Fall into ETF Investing event, a 4-part YouTube series premiering on October 18th, 2024, designed specifically for DIY investors. Check out these exciting weekly events we curated specifically for you, the DIY investor. Our special guest speakers and insightful industry experts will provide the information and education you need to gain confidence and empower you to manage your portfolios. You won't want to miss these weekly specials.
Hey everybody, it's Larry Berman here. Interesting start to the month of October. Seasonality in September, supposed to be the worst month of the year, was actually pretty good for capital markets overall. But as we've got here into early October, geopolitical tensions are heating up significantly in the Middle East. Oil prices are moving. A huge surprise on the upside to the strength of the U.S. employment situation, and a pretty notable shift in risk assets this week. So let's have a dive into the chart room and see what we learned. In the U.S. long end of the U.S. bond market, we've talked about TLT. We often feature it here week to week. You know, it is the big discounting factor when you talk about what type of multiple we should be paying for equity risk. And the bond bulls out there, we think, are quite wrong. Ultimately, the incredible amount of deficit funding into the future, as far as you could see, in my mind, is going to limit the bond market's ability to rally. With the wide levels we've seen over the past couple of years, should be support. We don't think the U.S. economy can handle the 10-year rate, the 5-year rate, up above 5%, where it got to, a year ago. And so with the Fed starting to ease now and likely to continue, although at a very moderate pace and probably a lot less than is still priced into the tape, the long end just can't rally here until we get visible evidence of a harder economic landing. And so there are those out there who are calling for that. I do think at the end of every business cycle, we have one. I am still in that camp, but as I've said here for months and maybe the past year, that's not coming until we see a significant decline in the labor market in the US, and we're just not seeing it. So, the failed breakout here on TLT above 100, and the pullback into the range probably means we're going to come back down below the 200-day average and test support. If you're just a pure technician, you don't care about fundamentals and what's driving things, this trend line here that I've just added is going to be one of your key test metrics as we extend this out for a couple of months, and where that might take the long end of the bond market, the TLT, down into the 92, 93 level in the next month or so. And if it holds there, then we could get a rally. But what's going to cause that rally, again, is only at this point real decay in the labor picture. And if we don't get that, then we do run the risk of breaking this trend line and seeing a dip below 90 on TLT. And that means the long end of the curve, 10 years back to 4.25, and the long ends back to 475. At that end, at those levels, we think it's a strong buy on the bond market. But in recent weeks, I get questions on BNN every week. I'm hearing people telling you to buy bonds in the newspaper, and I'm reading reports. In fact, my father-in-law, was over this week for the Jewish New Year celebration at our house, asked me the same question. I'm reading in the paper I should buy bonds, and by the time you read it in the paper, that's too late. You don't want to do that. So you really have to, if you're talking about trading bonds, you really have to look at the charts. You really have to look at support and resistance, because the bond market is a mean reverting beast, meaning it gets expensive and then it gets cheap. And when it's cheap, that's when you want to take your risk in the bond market. Having said that, when we look out and at the curve on what's priced into the futures market, SOFR futures market, or the swap market. This is the close of Friday, October 4th. And if I do a quick flip here and look at the same levels on Thursday before we got the employment picture, you can see across the curve there were still, pushing on 3 rate cuts, or a 50 and a 25 to the end of the year. But if we go back to earlier in the week, you can see again throughout the week we were seeing more and more pushback. So remember, on this day, Powell basically started walking back and saying, "Hey, this Fed is going to go slower." So if we go back even into the week before, Friday, you see 3 rate cuts. So, on the Monday, Powell says, "No, this Fed is going to go slower." And slowly, the 200 basis points of rate cuts that were priced in prior to Powell to where we ended up after the employment report, they've taken out almost 2 rate cuts for all of next year. That was pretty much priced into the curve. And now we're looking at just a little bit higher odds of 225s. In fact, the November meeting is pegged on 25, no chance of 50. I never thought there was, but again, if they're going to have to be more aggressive here, it's because the labor market is turning down. Other thing that's pretty interesting here to note, with the S&P going out pretty close to the high end of the range, is that the NASDAQ is still quite off the highs from July and the highs from September. And as we look at the Qs, we just are not seeing that really bullish behavior there. When we bring that out and look at the equal weight S&P, we did take out the July highs. Haven't taken out the September highs. If you look at an equal weight basis again, off the highs from earlier in the week, but not a breakout here. So when you're looking at the different parts of the U.S. market, S&P 500, higher, but it's just not convincing to me yet that this market can break out. We look at the Russell small caps that would benefit from the rate cuts. We're not seeing the price action there either. So what's going on in the Middle East? Crude oil prices spiking up. The retaliation, is this going to turn out to be, take supply out of the market in the Middle East? I've said this for a year now. I said it last week on BNN. I believe it in my heart of hearts. The October 7th anniversary coming up on Monday of the atrocious attack by Hamas on Israel, and the war that's lasted a year now is not going to end until Hamas and Hezbollah and all the Iranian proxies in the region are wiped out. And if you don't fundamentally believe that, well, obviously we have a different worldview. But, Israel's 9/11 moment, it's never again. It's never again going to happen. We're tired of living this way. So I believe it's going to keep going. And as long as Iran is pushing back on the other side, it's going to escalate. I don't know when. I can't predict anything like that. I'm not a geopolitical strategist. I just understand what never again means to the Jewish people in the world. And so, is this going to spike to $100 again? Are we going to get, the world, if you look at going back to 2022 when Russia invaded Ukraine and we had a really imbalance to the world supply for a short period, we saw this massive spike in oil. I think we can see that again at some point. Is it going to stick? It could stick for 3 to 6 months. Is it a permanent thing? But if the global economy is really slowing and China's really slowing and the stimulus that they're trying to put in isn't going to work, then yeah, oil prices should probably break down here, supported by the Strategic Petroleum Reserve replacement, etc. I think oil's in a range, but we're in the bottom end of the range, and I do feel the risk here is that oil prices are going to spike here. That is going to have to make the Fed go slower, because that's going to move some of the inflation indicators higher in the months to come. That would more than offset any softening in rental markets and stuff like that. So that's kind of my view on the world. The Fed's got to go slower here. A slower Fed, equity markets simply can't break out to the upside in my mind. Here's an interesting chart I think people should keep on their radar. This is Israel technology. Here's a year ago, October 7th, and the market was already weakening and breaking down. Maybe there was some maybe there was some selling of Israeli tech. Maybe some people knew what was coming. But really, in the last year, Israeli tech's been holding in, obviously deflating some of the bubble that came in and the wild speculation, post-COVID. This is a massive base here. I love Israel technology. I think in general, this thing could be ready to break to the upside again. But if we do see it break to the downside, that would imply, something more untoward in the Middle East in terms of, a real escalation of the war. So that's one chart to keep on your radar. Anyways, gold strong. The employment situation numbers that came out of the U.S. Really is going to dial back some of that euro strength and take the, aggressive Fed tightening out of the market. Much slower pace here, and that just means gold is probably peaked out in the short run as well here. So, taking some money off the table there, and just caution overall. The risk factors are way too high to be bullish on any kind of bullish economic scenario here on rate cuts in my mind. Rate cuts get more aggressive. It's because the U.S. economy is slipping into a recession and the labor market's turning over. If that doesn't happen, then earnings are going to be okay. So the equity market can hold, but the multiple shouldn't expand. And so I expect that at the best case scenario is, we grow into the earnings, meaning the multiple comes down as earnings grow. Doesn't mean the market needs to break out on the upside here. Anyways, that's all I have this week. Happy New Year to all my Jewish friends out there, and really pray for peace in the Middle East for everybody concerned.